All right, well, let's bring in our halftime headliner. Mike Wilson is back. He's the Chief Investment Officer and the Chief U.S. Equity Strategist at Morgan Stanley. Welcome back.
Thanks, Scott.
You still negative?
Well,
I mean, it just has to be as simple as that, right? We've had this big rally. You know, yeah. You've been on here saying that we're going to have a big pullback. Well, we had it, and now we're trying to put something together to the upside. Are you still negative?
Yeah, unfortunately, I mean, look, your panel described it for the most part. I mean, look, the risk setup is worse today than it was 3 months ago, just with the war itself, or just that alone. Okay, it doesn't even take into account the Fed moving faster now and the risk that that has on the economy. I mean, these are real changes that are for the negative. And so you can't be more positive than you were in December. And we were negative then, and the price isn't that difference at the S&P level. Now, the good news, Scott, as we've talked about a million times on this show, okay, we're in a bear market. We've been in a bear market for a while. It started a long time ago. We've done a lot of good work at the stock level. And actually, you know, last year, the average stock underperformed significantly the S&P. This year, it's probably going to be the opposite, okay? So what you guys are talking about, picking off names that have already been hammered, that's the strategy now. Get away from the S&P 500. It's a trap, okay? Like, thinking about the S&P is, you know, that's not what investors do. Investors look at individual names, and that's what you need to be doing. Now, at the S&P level, we're absolutely more bearish today than we were a month ago because the price is adjusted. And we thought there'd be a rally to 4,500. We wrote about that. Here we are. It's a bear market rally. And look, the numbers you guys are throwing around, I would throw 16 times. That's the right number right now, given where rates are, okay? The equity risk premium today is 280. That's the lowest equity risk premium that we've had since the GFC. Okay, that's the lowest number. Does that make sense to anybody? 280 equity risk premium. You're not getting paid to take equity-like risk at 280 basis points. No different than credit spreads, which have blown out here recently. So what's the right equity risk premium in this environment? We have a war going on. You have a Fed that's moving us to inversion quickly, and growth is, you know, not negative, but it's slowing. Okay, that setup says 400 basis points. That's 16 times. I don't think it's that complicated. The hard part is knowing when we're going to get to 16 times. Is it going to be next month? Is it going to be 2 months from now, 3 months from now? I don't know. But I'll tell you this, I'm not that interested in buying the index until we trade to 16 times.